the number 100, 500 rather. Audit evidence. So as per our syllabus, we are not required to cover so much. Just to remind ourselves about financial statement assertions or management assertions. Then we look at something else. We know that auditors will never be in a position to form an opinion if they are not able to gather sufficient, appropriate audit evidence. Otherwise, if they are not able to gather such, that's why you find them modifying the report citing limitations on scope. If you can recall what was limitations on scope. We'll modify citing limitations on scope when we are not able to gather all the evidence which we expected. So if there are some evidences that we expected and we have not been able to gather, then we modify our opinion. So we introduce and say, yes, this relates to the information and explanation obtained by the auditor, to enable them from an audit opinion. 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 Enable them from an audit opinion. The evidence gathered has to be Roman number 1, sufficient. Roman number 2, appropriate. Has to be sufficient, has to be appropriate, has to be sufficient, has to be appropriate. So when you talk of Roman number 1, sufficiency of audit evidence, we say that this is the measure. This is the measure of quantity. And this is the measure of quantity of audit evidence. Measure of quantity of audit evidence. So it's measure of quantity. It's measure of quantity of audit evidence. It's measure of quantity of audit evidence. Then we summarize by saying evidence is considered to be sufficient if it clears all the doubts. If it clears all the doubts. Yeah, if it clears all the doubts, then that evidence is sufficient. If it clears all the doubts, that you're not left with any question, that evidence is sufficient. When it is not sufficient, that's when you proceed. That's when you proceed to gather using other avenues. Maybe you inquired for management, but you feel it's not sufficient. You go for third-party confirmation. You still feel it's not sufficient. You go for recalculation and performance until all doubts are cleared. Until all doubts are cleared. Roman number 2, we talk of appropriateness. Appropriateness. So we say, this is the measure. This is the measure of quality. Measure of quality of evidence. It's the measure of quality. That's relates to the matter's quality, relates to the matter's quality evidence, i.e., A, reliability, and B, relevance. We measure reliability and relevance. We measure reliability and relevance. Now, on matters reliability, we hear this even with police. Sometimes they will be given some evidence of some occurrences of some happening, and they'll say that evidence is not reliable because it is contradicting, different sources are contradicting. You ask person A, person B, you're giving contradicting information. So contradicting evidence can never be considered to be reliable. But if I checked with the reception, how much you paid today as you came in, then you confirm the same. That evidence is reliable because it is consistent. It is consistent. So you say evidence is considered to be reliable when evidence from different sources is consistent. Is consistent. Then we have some generalizations. The topic here. Generalizations on reliability. Generalizations on reliability. Generalizations on reliability. We say Roman number 1, evidence from original documents is more reliable. Than evidence from photocopies, facsimile, or digitized documents. So keyword, original documents more reliable than photocopies. Then we say, number 2, documented evidence. Documented evidence is more reliable than oral evidence. Roman number 3, we say, evidence gathered by the auditor himself is more reliable. Is more reliable than from any other source. Roman number 4. Evidence gathered from external sources. Is more reliable. Than internally generated evidence. More than internally generated evidence. Then number 5, we say internally generated evidence generated evidence will be considered to be reliable when the internal control systems, when the internal control systems used to generate and maintain the evidence or the information is assessed to be strong. So if it matters on procurement, if the controls guiding us on procurement are strong, then we may consider that evidence to be reliable. We can consider that evidence to be reliable. And of course, this opening statement here, evidence is reliable if evidence from different sources is consistent. Yes, number 6, it's this point. Considered to be reliable when evidence from different sources is consistent. So when evidence from different sources is consistent, we consider it, before relevance is reliability. Before relevance is reliability. Then we have the relevance. Yes, evidence. So it may be to take you through from original documents more reliable than photocopies, or even from faxed document, or even digitized. Tunapiga picha siku hizi documents. Original is more reliable than all those. Evidence documented, ile imeandikwa. We know even some oral evidence will not be permissible in a court of law. So we know documented is more reliable than oral. Evidence that the auditor has gathered himself, has seen with his own eyes, has touched, has verified, has inspected, more reliable than from any other source. So evidence gathered from external sources, for instance, if I asked a debtor how much they owe an entity, that will be considered to be more reliable than when the same evidence is generated internally, because we know management and their employees have got some vested interests. Evidence which is internally generated will be considered to be reliable if the internal control system surrounding its maintenance, preparation of their books of accounts are assessed to be strong, and evidence is reliable if from different sources it is consistent. Now, so matters relevance is the evidence is considered to be relevant if it is maintained as per the relevant, legal and professional guidelines, and if it relates to the client, and if it relates to the client, so it is as per IAS, IFRS, and it relates to the client, then it is relevant. We don't need the information relating to another client. It is with regard to the client that we are auditing. Then if it is with regard to the client that we are auditing, that evidence will be considered to be relevant inatuhusu, but any other evidence may not be relevant at all, Now, most importantly, we need to look at the financial statements subtopic. Financial statement, stroke management assertions. Actually, that's what the syllabus reads. We are supposed to look at assertions, but we had to introduce through. Yeah, this is assertions. It's in topic number 5. Somebody asking which topic is this? Yes, I've just added that bit of introducing evidence. Otherwise, it is topic number 5, the first item. Audit assertions and how to identify the relevant assertions during audit process. So that's it. Topic number 6, audit evaluation and reviews. Now looking at assertions. Assertions. So introduce and say, these are declarations made by the management, declarations made by the management when preparing the financial statements, preparing the financial statements, when preparing the financial statements, full stop. They could be implied or express. So implied are those that are over there, unless expressly excluded by the persons concerned. Express are captured in form of a writing. All right. They are discussed using the acronyms. Using the acronyms, we talk of ACCA, and we talk of cover. ACCA and cover. So A is an accuracy. C is on cutoff. Stroke measurement. The other C is on completeness. Stroke disclosure. The other A is on allocation. C is on classification. O is on occurrence. V is on valuation. E is on existence. R is on rights and obligations. Rights and obligations, stroke ownership. Accuracy, cutoff, stroke measurement, completeness, stroke disclosure, allocation, classification, occurrence, valuation, existence, rights and obligations. I believe the last time we tested this was in around 02. And it was question number 1. Sorry, it was question number 1, but with 20 marks. 20 marks. Those are like 20 years ago. But they can always test. They had given us an asset. They are calling it molding machine. And they were asking us to list down the assertions that we can test and how to test those assertions. Round 02, December, question number 1. Yes, excused. Yes? Got that. And I recall. There was something of that nature. Maybe I need to check. I think I've done several cuts for several institutions. I can't recall. I'll confirm. There was an assertion thing. Eh? Yes. Yeah. Number 4. I'll check. I'll check. So there was an assertion thing. Eh? Yeah, the reason why I would have brought it there is we discussed these assertions when we discussed assurance engagements. Yes, when we covered that, we said auditing is an assurance engagement because of 2 or 3 reasons. 3 reasons. Number 1, we can trace the 5 elements of assurance engagement in auditing. Number 2, both of them are involved in testing management assertions. Number 3, both of them form an opinion at the end of the exercise. So that way we can now comfortably or without fear of contradiction that auditing is an assurance engagement. Auditing is an assurance engagement. So all these assertions are classified into 3. A, assertions. Assertions relating to account balances. Account balances. Assertions relating to account balances. This translates to B-sheet items. B-sheet items. What assertions do we test with regard to B-sheet items? We talk of the DAB acronym. DAB acronym. These are the assertions we test. So D, it's the disclosure there. Disclosure. Disclosure stroke completeness. O is on ownership. Stroke rights and obligations. V is on valuation. Sometimes we talk of valuation and accuracy. E is on existence. So we are saying, like if you find some motor vehicle recorded in the B sheet, unless otherwise, this motor vehicle existed as at the B sheet date. This motor vehicle was properly valued, IAS number 16, at cost net of accumulated depreciation. This motor vehicle belonged to the client, and all the motor vehicles were recorded, no omission. That's what you're testing. That's what you're testing. That with regard to motor vehicle, for instance, Roman number 1, on matter of disclosure, how can you verify this? You verify disclosure that nothing was omitted through ISA number 580, management representation letter. Management representation letter. This is a requirement of ISA 580 that management writes us a letter indicating that there is no omission. Everything was recorded. Roman number 2. What about the element of ownership? It's about inspection. You inspect. Inspection, what are we inspecting? Document of title. Documents of title. Of course, that's the road book. What about valuation? Recalculation. Recalculation. You recalculate. See, they are saying depreciation is at 20% per annum. Do it, recalculate it using the cost to see whether the figure captured is the correct figure. That way, you have confirmed whether it has been properly valued and that the figures are accurate. Comment number 4, about existence. All right, all right, all right. Sorry for that. It has sorted, has been sorted. All right, so you're saying we are testing these assertions, the above acronym disclosure, ownership, valuation, and existence with regard to all the B-sheet items, We would use the same assertions to test on matters plant-end machinery, branded buildings, trade payables, trade receivables. We've even checked on the cash at bank, cash in hand, all the assets, all the liabilities, the capital items. We are testing them using the DAV acronym. All right, we look at assertions relating to account transactions. That is B. Assertions relating to account transactions. This way, we are referring to the income statement items. Income statement items. As there's an acronym that was given by my students of COCA. COCA, yes. Doctor of COCA. COCA like that. That you're testing cutoff, stroke measurement. We are testing occurrence. We are testing classification. We are testing completeness, stroke disclosure. We are testing accuracy. And those are the 5 assertions we test with regard to income statement items. So on interest, returns outwards, returns inwards, advertising, salaries and wages, all those, we test these assertions. So the assertion of cutoff, we are checking whether items have been recorded. Yes, recording items in the correct financial period, Yeah, that's when you apply the accrual concept. You add accrued to ensure you record items for that year. You will subtract repayments to exclude them. That's observing cutoff assertion. That's observing cutoff assertion. How can we confirm this? Do inspection. Can do some inspection. Inspection and recalculation. Although you can still seek management representation later. ISA 580. Now I'll not elaborate what it is. By now we know ISA 580 is a management representation. You can become management to confirm to you that cutoff has been observed. Cutoff has been observed. Yes, now about occurrence. Occurrence is like if you are indicating salaries and wages, did that happen? So you can always, about the occurrence, you can inspect. You can do inspection. Inspection, you are checking the payment vouchers. You are checking the logins, the clock in and clock out system that employees came in, if you're checking on the salaries and wages. If it's rent, you check the lease agreement, you check the bank statement that payments are, you're inspecting records to confirm that that which has been recorded occurred. All right, about classification. Classification is ensuring that we have recorded, we have not committed what we call error of commission. And especially, and another error of principle. You know what is an error of principle? An error of principle is when you record in the wrong class of accounts. Error of commission, you are recording in the right class of accounts, but in the wrong ledger account. Hiyo tumeshika. Acha nikuelezee principle hii ya recording in the wrong class of accounts. If you disposed a motor vehicle, then these disposal profits find themselves in the sales account. That's error of principle. It should not happen. It should not happen. So we expect to find revenue items recorded as revenue items, and especially revenue incomes and revenue expenses. Those are the ones we record in the income statement. Capital incomes, capital expenditure will only find themselves in the cash book. When we purchase motor vehicle, we don't expect to find it in the income statement. That's error of principle if it happens. So that's what you're checking. And classification, that error of principle has not been committed. We can confirm this again through inspection again. It's inspection or what else? Yeah, inspection is one of them. And recalculation. Recalculation. All right. We have number C, completeness. Completeness we confirm through management representation letter. That remains. We can put it here. Can put it here. Roman number 4, completeness. We confirm this through ISA 580. Let it be that way so that you can fresh and recall what it is. Then we have accuracy. Roman number 5, accuracy. Accuracy is about recalculation. Recalculation, and maybe we can also do ISA 520. Recalculation and analytical review procedures. Remember we said ARPs will enable us to check plausible relationship. So plausible relationship is part of accuracy. Plausible relationship in the financial statements is part of accuracy. Perfect. That's done. So you can confirm that we have discussed all the assertions apart from allocation. All these other assertions, we've classified them as either assertions relating to account balances or assertions relating to account transactions. So this one on allocation, we discussed it under item number 3. Let's out this back. I believe one Moses Sotieno, you can hear us. Now C, assertions. Assertions relating to presentation and disclosure. Assertions relating to presentation and disclosure. So generally, that's why we discuss on 1, allocation and classification. This means that B sheet items are recorded in the B sheet. income statement items recorded in the income statement items. That's allocation. You know, B sheet records the accounting equation. Assets equals to capital plus liabilities. That's what it confirms. Confirming that transactions and balances have been recorded in the right accounting statement. This can be confirmed through ISA 580, management representation letter, and inspection. Then all the others follows. All the others follows. So assertions relating to presentation and disclosure are all the assertions. All the assertions. So you can find us discussing like valuation and accuracy. Valuation and accuracy. Well, number 2, you can find us discussing ownership and disclosure. Ownership and disclosure. Before, you can find us discussing existence and occurrence. Existence and occurrence, that all the assertions, even the cutoff. So all the assertions relates to presentation and disclosure. All the assertions relates to presentation and disclosure. That's it. That's it on assertions. That's it on assertions. That's it on assertions. And there's a question, we look at something else. It's a 560 subsequent events. Honoring family, I believe we are through with that. If you're screenshotting, can screenshot very fast. So that introduce something else. Section is asking whether we have any notes. Yes, I'll be availing some notes. Or they are in the notes that somebody was saying they belong to intermediate. Somebody was saying they belong to the intermediate. First assertion, disclosure. Disclosure stroke completeness. Najua that side kuna kitu unawaficha hapa. This is disclosure stroke completeness. That no omission. Everything has been recorded. No omission. Yeah, I would like below that mark of no card in camera. So that's noted. I'll make sure I don't write on top there. But you get it. So this was assertions relating to account balances dash B sheet items. The one that is not visible. Assertions relating to account balances. That's balance sheet. Assertions relating to account balances. That is balance sheet. Oh, there's something disturbing on in class here. Let me report it here.